All right, welcome to chapter 28. We're diving into an incredibly important area of economics here, monetary policy and banking regulations. This topic affects our daily lives in pretty profound ways, even if we don't always see it. So here's the agenda for today's lecture. We'll start broadly with an introduction to get a foundation for some of the key concepts of monetary policy and bank regulation. Then we're going to examine the Federal Reserve banking system and the role of central banks globally. From there, we'll move to how banks are regulated to ensure stability and to protect depositors like you and me. And next, we will really break down the mechanics of how a central bank executes monetary policy to help steer the economy. We'll explore some real-world outcomes of monetary policy and how it affects jobs and prices and overall economic health. Finally, we're going to wrap up by considering some of the potential pitfalls of monetary policy because no system is perfect. So let's start with the basics. That's what we're going to cover in this video. What exactly are monetary policy and bank regulation, and why should we care? So think about how money flows through our economy. It starts with deposits in bank accounts, and these deposits, they're not just sitting there. Banks lend that money out to individuals, to businesses, and even to other banks. And this interconnected web of money flow is what allows us to seamlessly buy groceries and to pay our rent and to invest in businesses. I mean, when this system works smoothly, it's a well-oiled machine. It facilitates economic transactions in every market, from goods and services to labor. It connects the savers with the borrowers, which helps to drive economic growth. And that's a big part of what banking is all about. It's connecting the savers with the borrowers. But the crucial point here is that the system is delicate. Disruptions can cause chaos and instability. If you think about recessions where businesses fail and people lose jobs, or you can consider periods where we have persistent inflation that erodes the value of our savings. We need to understand how monetary policy can help to interact with these macroeconomic factors. So that's where public policy steps in. And monetary policy is public policy. Governments worldwide recognize the importance of a stable monetary and banking system. So governments create policies to support this framework. And a key policy tool is monetary policy. There's also fiscal policy, which is more a function of your elected officials like the president and Congress. Monetary policy happens from the central bank, the Federal Reserve, as we'll see, right? So with monetary policy, a central bank can do things like adjusting interest rates, which then manages the credit conditions to help steer the economy. The central bank's best way I can describe it is think of them as the central bank is the captain of a ship, and they're navigating through unpredictable seas. And just as the captain adjusts the sails and the speed and the direction to help stay on course, the central bank adjusts interest rates and credit conditions to help keep the economy moving steadily and smoothly. So yes, there are storms, there are financial crises, there are inflationary pressures, there are economic recessions, there are elected officials who try to enact fiscal policies that interact with all of this. The central bank is kept separate from the political pressure, and it uses the tools at its disposal to stabilize the economy and keep it from veering too far off course. All right, so the purpose here is noble, right? We want to keep the ship steady. We want to curb the high waves of inflation. We want to foster economic growth. We want to help the economy reach its destination safely. But just as the best captain can't control the weather, central banks face limitations and challenges. Economic forces are unpredictable. Not all the factors are within their control. Global market fluctuations or sudden economic shocks can disrupt the central bank's plans, making it harder to keep the economy on a stable path. So despite the best efforts to steer in the right direction, there's always going to be external factors, and the complex nature of economic forces can sometimes lead to some unexpected outcomes. In the movie Too Big to Fail, There's a powerful scene where Ben Bernanke, which is played here by Paul Giamatti, explains the devastating impact that a freeze in the credit markets can have on the entire economy. He emphasizes that when the credit markets seize up, it's not just Wall Street or big banks that are suffering, it's everyday people. So without functioning credit markets, businesses can't borrow to pay their employees. Homeowners can't get loans to buy houses, and even basic consumer credit grinds to a halt. Bernanke's point here is that credit is like the lifeblood of the economy, and when it stops flowing, the entire system shuts down. And so this scene here highlights why central banks, like the Federal Reserve in the United States, intervene in times of crises to restore confidence and keep credit moving. So let's take a look.
I spent my entire academic career studying the Great Depression. The Depression may have started because of a stock market crash, but what hit the general economy was a disruption of credit. Average citizens unable to borrow money, to do anything, to buy a home, start a business, stock their shelves. Credit has the ability to build a modern economy, but lack of credit has the power to destroy it swiftly and absolutely. If we do not act boldly and immediately, we will replay the Depression of the 1930s, only this time it will be far, far worse. We don't do this now, we won't have an economy on Monday.
All right. So here's one major challenge that economists have grappled with. It's called the 0% interest rate lower bound. Now, typically monetary policy tries to stimulate the economy during a downturn. One way we can stimulate the economy is by lowering interest rates, which makes it cheaper for businesses and for consumers to borrow money and to spend that money. But what happens when interest rates are already super, super low or close to zero? Well, we can't go negative. So the central bank's ability to stimulate the economy through further rate cuts when they're already down low is really, really limited by that zero threshold. It's like hitting a wall or hitting a floor that you can't get underneath. You can't go past that wall. You can't break through, or else you're risking just giving money away. That's what negative interest rates means. You're literally giving money away. So that limitation, the 0% interest rate lower bound, it can be kind of a headache for policymakers, just something to be aware of in all this conversation. So now let's look at a real world example. The US Federal Reserve, or what we call the Fed, it had a pretty crazy experience with the zero lower bound here recently. During both the 2008 to 2009 Great Recession, or what we call the 2008 financial crisis, and the 2020 COVID-19 recession, the Fed was confronted with this problem. So back in 2007, the federal funds rate, which is the interest rate that banks charge each other for overnight loans, was just over 5%. But as the economy went into a tailspin, the Fed, the central bank, the Federal Reserve, the Fed slashed the interest rates and they got really aggressive. And by 2009, the federal funds rate had gone down to 0.16%. Fast forward to 2020, and we see a very similar pattern. The Fed funds rate was above 2% when the pandemic hit. Okay, and then the economy went into lockdown. Everyone shut down. Everyone stayed at home, and then the Fed starts to cut rates again. They cut them dramatically, bringing them back down to a range between 0.05 to 0.25% by March of 2020. So again, the purpose of lowering these rates is so we can stimulate the economy and get people borrowing and get people spending. But when you get that interest rate so close to zero, you can't go negative. So with those interest rates as incredibly low as they were, the traditional monetary policy tools like adjusting the federal funds rate wasn't really enough to jumpstart growth. And so policymakers had to get creative and they had to find some new ways to support the economy. And they did that through things like stimulus, extra money on unemployment, things like that. And in addition, they've also switched to a different, we'll get to it. Don't want to get too far ahead of myself. So during the 2008-2009 recession, fiscal policy faced limitations like the one we just described. Fiscal policy faced limitations, right? Fiscal policy is what happens through Congress and the president. Those are the elected officials. There were concerns about skyrocketing the federal budget and federal budget deficits and putting in more public debt into our system. And policymakers, Congress, was hesitant to then start just pumping more money into the economy through government spending. The more the government spends, the more debt that they have to take on. And they didn't want to do that. And so that kind of restricted the Fed's options, the Fed being the central bank over top of monetary policy. The Fed had to do some additional economic support through their methodologies. So when the Congress won't do something because they're afraid of too much spending in the government, that kind of puts one hand behind your back. You don't have fiscal policy, so what do you have left? You've got monetary policy, and you've got the Fed who enacts monetary policy, and they do things in a very independent way, right? Fiscal policy and monetary policy, there's an invisible wall between the two that we try to keep. So now, during the COVID-19 recession, fiscal policy played a more active role, right? We had significant government spending to support businesses with things like the PPP loans, to support individuals with things like stimulus checks and unemployment benefits. But even with all that, right, the sheer severity of that economic downturn demanded that even more innovative approaches come through from the Fed, and so we'll talk about some of that. This here is actually the Mariner S. Eccles Federal Reserve headquarters building in Washington, D.C. So, right here is where some of the most impactful decisions about U.S. monetary policy happens in our government. So that's going to wrap up this video here. In the next video, we're going to cover more about the Federal Reserve banking system and central banks. I'll see you in that one.